Today, we're going to dig into something really strange that's playing out across America's heartland. It's a story about money, it's about land, and, it's about a financial system that kind of seems to be operating by two completely different sets of rules. Okay, so let's just jump right into the core mystery here. How is it possible that rural America is seeing banks close up shop and local economies struggle, while at the exact same time, the price of farmland is just going through the roof? I mean, it doesn't seem to add up, right? So let's break down the financial engine that's actually driving this paradox.
So to really get this, you have to understand that the financial world isn't the same for everyone. The kind of tools you have access to in a big city are just fundamentally different from what's available out in the country. Folks in the city are often shielded by things like 30-year fixed mortgages, but rural producers, they're totally exposed with loans that can change on them overnight.
And a huge piece of this puzzle is the fact that local banks are just disappearing. Think about this. Since 1994, almost half of all bank branches in non-metro areas have closed. This isn't just some small inconvenience. It completely guts what's called relationship-based lending, where your local banker actually understands the cycles of farming. That local knowledge is absolutely crucial for a healthy farm economy. Okay, so this growing vulnerability, it sets the stage for this really powerful mechanism that the source material calls the interest rate whip. This is where big picture policy decisions from on high end up creating this deeply unequal shock on the ground. So what in the world is the interest rate whip? Well, it's basically the built-in difference in loan products. If you're a homeowner in the city with a 30-year fixed mortgage and the central bank raises interest rates, you barely feel a thing. But if you're a farmer with an operating loan that resets every year, boom, you feel the full force of that hike immediately. It's a built-in structural imbalance. And this comparison right here shows you just how fast a farmer's entire world can get turned upside down. In 2021, their loan might have a 4% interest rate, totally manageable, just a cost of doing business. But fast forward to 2024, and that very same loan can suddenly be sitting at 8 or 9%. I mean, just imagine one of your key business costs doubling in a couple of years. And this number, wow, this shows you the raw power of that whip. We're talking about a 40 to 60% jump in what you pay in interest every single year. For any business, an increase that massive can be the difference between making a profit and facing a total disaster. So here's the real kicker. While big city corporations have all these fancy financial tools, things like swaps and derivatives, which are basically a form of insurance against interest rate changes, rural producers are often left completely exposed. They're forced to take on all that risk, as the source says, naked. Now, this intense, uninsured financial pressure doesn't just squeeze profits from one year to the next. It has a much bigger, much more profound long-term effect. By making farming so incredibly risky, it fundamentally changes who can even afford to own the land itself. And this leads to what the source material calls a new enclosure movement. Yeah, it all really kicked into high gear after the 2008 financial crisis. Policies that were designed to save the wider economy, like keeping interest rates at rock bottom, had this huge unintended side effect. They made farmland look incredibly attractive to big institutional investors. We're talking pension funds, private equity, who saw it as a safe place to park their cash and protect it from inflation. And you can see the result right here. I mean, look at this chart. Between 2008 and 2023, the biggest institutional investors cranked up their farmland holdings by a jaw-dropping 231%. This is not farmers buying more land from their neighbors. This is a policy-driven flood of outside money pouring in. This is what leads to something called farmland financialization, and it's a huge deal. It means that land prices are no longer connected to how much corn you can grow on it. Instead, they're tied to global financial trends. The land just becomes another asset in a portfolio somewhere far away, and local farmers, especially the young ones trying to get started, they just can't compete. They're priced out. Let's look at this like an accountant would for the community as a whole. The books look pretty grim. The value of the main asset, the land, is going up, sure, but that wealth is going to outsiders and absentee landlords. Meanwhile, the debts of the local farmers are skyrocketing as their loans get more expensive, which means their actual net worth, their equity, is shrinking. And if you think the balance sheet looks bad, the future cash flow looks even scarier. That flow of money, the lifeblood of any community, it actually starts to reverse. Young farmers can't afford the down payment to even get in the game. That critical process of one generation passing the farm down to the next, it just stalls. The community starts to hollow out from the inside.
Now, what's happening today might feel like a brand new 21st century problem, but the basic mechanics of it, they're not new at all. In fact, the core of this issue was diagnosed more than 200 years ago by the father of modern economics himself. All the way back in 1776, Adam Smith warned that giving a small group of people discretionary power over money was a really dangerous idea. He was afraid it would get captured by powerful special interests and lead to what he called unequal monetary privilege. And that's pretty much the exact scenario we see, where wealth just compounds for people who own assets, while wages for people who actually produce things just kind of stagnate. And this quote from the source material, which is inspired by Smith, it just absolutely nails the core issue. When the tools of finance, the types of loans, the ability to protect yourself from risk, aren't available to everybody, then the pain from economic policy doesn't get shared fairly. It falls hardest on those who have the least amount of power. But, it's one thing to diagnose the problem. The source material doesn't stop there. It actually draws on these really deep historical warnings to propose a detailed architectural solution for a fairer system. The big idea is to create something called a Smithian monetary charter. And the goal is to shift away from a system that relies on what the source calls magisterial judgment, which is basically just the gut calls of a few powerful individuals, and move toward a system that's governed by clear, predictable, impartial rules. So think of it less like a series of improvised decisions and more like a real constitution for money. So this charter isn't just a vague idea. It's built on specific articles designed to prevent the very problems we've been talking about. For instance, Article 1 says policy should aim for steady growth for the whole economy's income, not just focus on one metric that might accidentally pump up asset bubbles. Article 3 demands neutrality. The system shouldn't be picking winners and losers. Article 4 tackles the revolving door problem head-on to stop regulators from being captured. And Article 8 directly takes on the banking desert crisis, making sure that what's happening to rural credit is actually tracked and addressed. And, critically, the charter would build in specific safeguards so that rural economies aren't just an afterthought anymore. It proposes things like actually stress testing for farmland bubbles, using special rules to help small local banks survive tough times, and making sure policymakers have to listen to rural experts and historians who actually understand the context. So why does all this matter? Well, at the end of the day, the goal is actually really simple, but it's also profound. It's about realigning our financial system with the real economy. It's about designing a system that rewards productive work, not just owning financial assets, and a system that protects the most vulnerable parts of our economy instead of concentrating all the volatility there. And this all brings us to the fundamental question that this entire analysis poses, really. Is it actually possible to build a system based on impartial rules that can restore some kind of economic balance? Or have we created a world where your zip code has become your financial destiny? We'll leave you with this final, really powerful thought from the source material. The current system, with all its whipsaws and imbalances, has forced the very people who produce real things, our food, our resources, into becoming gamblers. They've become involuntary speculators on interest rates instead of being rewarded for their skill, their hard work, and what they actually contribute to the real economy.